The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to another edition of the live Advanced Technical Analysis course. Today's webinar is webinar number 12. That means we've arrived at the end of this course. It's been a 12-week, or rather 12 webinar course, and in today's webinar we will be running also the final of the 3 course workshops. In today's workshop we will not only look at incorporating in a more practical manner the subject matter that we've looked at over the course of the past 3 days, but we will also illustrate how you can incorporate some of the other elements that we looked at over the entire course in terms of using those tools and techniques with regards to illustrating how you can develop a more disciplined approach to both analyzing and trading the financial markets. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All of the content that we have reviewed over the past 12 webinars have been educational material with the purpose of introducing you to the tools, techniques, and methodologies under the subject of technical analysis. Hopefully over time, you will be able to incorporate some of these approaches, and that will then contribute towards an improvement in your ability to both analyze and trade instruments in the financial marketplace. Before we continue, just a few pieces of housekeeping issues. Please feel free to ask any questions throughout the course of this webinar. You can locate your chat box on the right-hand side of your screen. I will obviously be able to see those questions. It is a live webinar and will be recorded. And following the conclusion of the webinar, it will be placed in your members area. At the end of today's session, we will, as always, be hosting an extended Q&A session, which will facilitate and allow you to ask additional questions and also perhaps provide more of an environment where we can go into a more detailed discussion in terms of responding to the issues that you raise. This week has followed the same process that we've seen in the previous weeks, whereby in the first 3 days of the week, we have covered some educational material, and we'll end off the week as well as the course today with the end of course workshop. In today's webinar, we will be applying a certain logic to the workshops as we have with the previous 2 in terms of illustrating how you can incorporate technical analysis into a solid trading plan. We'll also illustrate how you can develop robust skills which are necessary to more effectively read markets. We'll also have some final thoughts and perhaps some final considerations at the end of the webinar. Let's just recap a few of the items that have been discussed in the 3 webinars that we have looked at thus far this week in terms of laying the foundation for an illustration into how you can incorporate technical analysis into a solid trading plan. We looked at the issue of technical, fundamental, and sentiment analysis, and we came to the conclusion that combining these 3 approaches helps provide a clearer picture of the market. Therefore, you should consider employing to a greater or lesser degree all 3 of these components in your analysis. These approaches can lay the ground for your strategy once you've established your directional bias. Remember, the directional bias is absolutely essential in terms of the very first step before you even embark on looking to identify potential trading opportunities. You need to establish in your mind whether you believe the market or that instrument that you're looking to potentially trade is likely to move either in an upward direction or a downward direction, or perhaps a range has established itself, and then you may consider employing certain strategies around a range trading approach. We looked at Fibonacci techniques and Elliott wave analysis, and we saw how both these approaches can provide an important set of tools contributing towards an additional clarity in terms of the market's underlying condition. Whether the market is trending or range bound is always going to be an important observation, and an observation that you as an analyst prior to taking the trade will need to identify. When it comes to order flow, we should always try and assess whether we can draw any conclusions relating to order flow. We ended off yesterday's webinar with a brief discussion on confirmation, or rather price confirmation, and it became clear that once you've determined the type of price confirmation filters that you are going to be working with, you need to apply these when you have identified any particular or significant developments in price action. What we'll do now is we will look at illustrating how one can develop a strategy in a real-time framework, and our focus is going to be on the dollar index. Now, the process that we will follow for this is really just a basic framework that we believe you should employ and approach for any instrument or any trade idea that you are focusing your attention on. What you should always do is just get a reevaluation of the historical performance of that instrument. So from the dollar index perspective, what we would do is, before we begin in terms of focusing our attention on the more recent price action, essentially that's what we're going to be focusing our decision-making process against from a trading perspective, let us evaluate developments in the dollar index since December 2016. We'll look at very shortly that a downtrend began off the 3rd of January 2017 and continued until the 16th of February this year. Since the 16th of February, the dollar index began to move sideways until finally confirming a reversal on the 24th of April. This was then followed by a strong impulsive rally. The question we need to ask ourselves now is whether the dollar index is still a buy. Now, what I'm just going to do very quickly is we'll just take a look at a chart of the dollar index, just to recap some of the points that we just highlighted, and in terms of evaluating where price action is today in relation to where it has been trading. So this is the price information that we have in front of us. Our focus of attention will be on the fact that the market started a long decline which dominated 2017 in December of 2016. That trend continued throughout the course of 2017 and into the early part of this year. As we mentioned earlier, back in February, the market found a low and for a few months continued to trade sideways. Eventually, we saw an upward break in price action, and that has resulted in a strong impulsive rally. The question we need to ask ourselves now is whether where prices are currently at, or at some point in the near term, does this market offer a buying opportunity? Remember, it is very important for you as an analyst to identify the current direction in the trend. If the current direction is up, you will always start your focus of attention from a bullish perspective. Unless, however, you feel there is enough evidence already to suggest that the market may indeed be turning, and therefore you will be focusing your attention on trading the opposite direction. At this stage, we will just stick with the current trend that has essentially been up from this year's low over the course of the past few months. Okay, so it is always very important to approach the markets firstly, or approach any market that you're looking to trade, firstly by evaluating its recent historical performance. If you can understand what the recent historical performance is, it'll give you a much better basis or a much stronger backdrop in terms of building a strategy based on the more recent or current price action. Therefore, if we look at the chart again that we just focused our attention on, we can identify a few elements. Firstly, we identified the key developments, and we need to ask ourselves whereby the trend was actually moving in a downward direction. We know that the market was moving down and it is currently moving up. In other words, we have to ask ourselves, has there been a trend reversal? If so, how have we established this? And therefore, what conclusions can we arrive on the back of this particular chart? Now, if we start to look at the chart in a little bit more detail, and we can start to apply some of our technical analysis tools, you can clearly see that there is a trend line that is certainly valid. In other words, it's a good representation or a good fit of the underlying trend. How do we come to this conclusion? Well, we take the two starting points, which are essentially these, and this line has been projected forward. We can see that when price traded up to the trend line over here, as well as on this occasion, the market sold off. In other words, if we had blindly followed the trend line and sold every time it hit the trend line, we would have had at least two decent trading opportunities. Remember, the more times a trend line is tested and validated, the more significant that trend line becomes. What we've noticed is that at this particular point over here, the market has moved through the trend line resistance. Therefore, at this stage, we can say to ourselves that a trend line reversal has indeed been identified. The current trend then needs to be regarded as bullish. Can we apply any additional tools to help further reinforce this reversal and current trend, such as, for example, moving averages? What we'll do now is we'll go back to the chart that we just looked at, and we will take a look at this. You can see that the trend line has been drawn. The break occurred at this particular point. It is also worthy to note that the move above this high over here resulted in the development from a price sequence perspective of a sequence of higher highs and higher lows. The pullback during this phase stalled at this point, failing to break the previous low, and then the market started to move higher. So from a price definition, or rather a trend definition perspective, we clearly are seeing a sequence of higher highs and higher lows. The trend line break adds further fuel to that conclusion or reinforces it. Now what I'm just going to do is I'm just going to go back into the charting package and we will apply a moving average. I'm going to just start off with a 20-day moving average, and simply for illustrative purposes, we're going to take a simple moving average. That you might have a preference for a weighted moving average or an exponential moving average. But you can clearly see that simply if we just apply the slope of the moving average, that there are certain phases where the slope of the moving average is negative. In other words, reinforcing the existence of the downtrend. We can currently see that following the break of the trendline resistance, the slope of the moving average is currently positive. Therefore, that further reinforces the trend. If you recall our discussion on the slope of the moving average, that is used as a trend definer. In other words, whether the slope is positive or negative will dictate how we evaluate the direction of the trend. Now, the use of the parameter, we have 20 in front of us, certainly is something that will differ from one individual to the next. it's always a good idea just to perhaps test or just visually monitor other periods of the moving average to see what they might be telling you. So for example, if we go into the moving average and we just change the period to 50, we can see that we again have a positive sloping moving average. Okay. What prices like to do generally is they like to trade back to the moving average. You can, for example, see over here, markets pull back and then they pull away. There is an application with respect to moving average analysis whereby the deviation in price from the average might result in a corrective move back to roughly the territory of the moving average. So you can use, for example, a mean reversion logic when it comes to applying the moving average. If we, for example, look at this illustration, where prices were above here, you can see that very clearly. The distance between price and the moving average is quite far. Does this raise the possibility that price action will trade back to the moving average before moving higher? Let's take a look at another period. I'm just going to extend that up to 100. Again, you can see clearly this is a much smoother flowing moving average because it's a summary of the last 100-day closes. But again, you can see that price action currently lies significantly far away from the average. Does this then raise the prospect that perhaps near term, we may see a pullback all the way down to the average? Now, these are simply just questions and observations that you as an analyst will focus on. If, for example, the 100 period moving average is your principal moving average, then you will come to perhaps stronger conclusions around that. Whether you're using the 20 or the 50, likewise, they will dictate what you are thinking about in terms of price action. Just from an observational point of view, notice how from these levels, the market pulls back to the average before it resumes the downtrend. Likewise, from these levels over here, the market pulls back to the average before it attempts, at least in this instance, to reinstate the uptrend. So there is this concept of mean reversion around moving averages that you should at least take into account in terms of perhaps identifying possible extreme points in price action relative to the underlying trend condition that exists. In the same manner, as we just mentioned, is there a chance, if we're going to focus our attention on the 100-day moving average, that we will see a pullback towards the average, or at least close towards that average? This information may be relevant shortly. So, in this instance, we have a sequence of higher highs and higher lows in price action. We have a break of a trend line, and depending on whether you're using the 20, the 50, or the 100-day moving average, all three, importantly at this point in time, are establishing or have already established a positive sloping moving average. The one that is perhaps taking its time, understandably so, is the 100 period moving average, but it now does seem to appear that it has tilted to the upside in terms of the slope. So that gives you a good framework or a backdrop of a bullish scenario, which would then determine your directional bias. It looks like the market is up, therefore we will approach the dollar index from a buying perspective. Okay, so coming back to this particular chart over here, having established the technical condition, which is bullish, we can ask ourselves whether there are any fundamental factors that are driving the market. Now, I'll just state what these factors are in the market, but you as an analyst, by keeping abreast of the fundamentals, either by reading financial papers, newspapers, following any financial channels, or even picking up these points of interest within the internet, it is possible for you to have a strong understanding of the general fundamental backdrop that is driving markets. If you have been doing this with respect to the dollar, you'll be aware of the fact that over the last few months, essentially over the course of this year rather, the focus of attention has been on how many hikes we are likely to see from the Federal Reserve in the US. The market originally started with a focus on 3, potentially now that has increased towards 4. Underlying conditions for rate increases have been significant and have been an important focus on the market. Certainly from the bond market's perspective as well, one tends to focus their attention on the US 10-year note, and the yield on the 10-year note has crossed the 3% threshold, which is an important development both for the dollar in terms of a reflection on overall direction with respect to interest rates, but also potentially has an impact on the equity markets. That's not part of the discussion at this stage, but that is generally the fundamental backdrop. Now, why do we look at the fundamental backdrop? Essentially because it is always important to understand what is driving the markets. As a technical trader, you will be basing your decisions on the technical conditions and the technical signals that you identify. But being able to understand the fundamental backdrop will give you further information and provide a more informed backdrop in terms of either taking the decision to trade, or if you've already taken the decision to trade, provide a more informed environment in terms of which you can manage that trade more effectively going forward. Now, one thing that we did look at this week was the Elliott wave process, as well as the Fibonacci ratios. One question that we can now ask ourselves at this point in time is, does the wave structure provide any information in terms of developing a strategy? Now, you will recall that when we discussed the Elliott wave approach focused on a recurring wave pattern whereby a trend was made up of 5 waves, and then the correction of those 5 waves was made up of 3 waves. And this was the recurring wave pattern structure that occurs over and over again to dictate underlying trends. So let's follow the logic in exactly the same way by starting our focus of attention on the major downtrend, i.e. the high up here, to this low earlier this year. The reason for that is because if we can establish a wave structure, potentially even a complete wave structure, on the basis of the high through to the low, that can then allow us to formulate a strategy in terms of the kind of price action that we may see going forward. And if we do have some visual of how the market may trade in the future, we're getting much closer to the type of strategies that we can then consider employing. So, from a wave perspective, it is always advisable to take a look at the bigger picture and identify the bigger swings. You can clearly see that in this underlying downtrend, there are many swings in the market. Even if we just look at these, I'm just going to quickly draw over them. There are a whole host of swings. The advice from an Elliott wave perspective is simply to look at the main turning points. In other words, from a size perspective, they will be clear to identify in terms of their relative price moves to other swings. These two are clearly the 2 biggest swings within the broader decline. If we've identified those swings, we can look at the first turning point from the high down to the low as wave 1. Remember, the trend is down, so we need to identify a 5-wave sequence down. We know, because we can already see the information in front of us, that the market stalled at that particular high and then started to resume the decline. Does that represent wave 2? Price action moved all the way down to the point that we've now considered labeling wave 3 before we saw another sizable correction to the upside. That sizable correction to the upside was a pause in the overall downtrend, because we then subsequently see price action move clearly downward, breaking below the low highlighted by 0.3 and then arriving at lows of around 88 to 87. That was the low from earlier this year. We've then seen a period of consolidation and the market has subsequently moved higher. Now, from our earlier discussion, we already know that the current trend is up. And we've already come to the conclusion that the trend has reversed. We saw the trend line break. We've observed the slope of a number of moving averages, and we know that we currently deal with a sequence of higher highs and higher lows. Therefore, does that mean that we can place a wave 5 and a completed 5-wave sequence from the high in December 2016 to the low earlier this year? If that is the case, and we'll assume that that will be the structure that we'll adopt at this point in time, then we know that the market has to correct this 5-wave sequence in an upward direction, and that correction will be made up of 3 waves: A, wave B, and then the final third wave, known as wave C. So if we can just get a visual of that potential outcome, we then know that perhaps price action might trade somewhere along the lines of what we've illustrated in the chart with the 3 directional arrows. Does that mean that the 3 waves will take that form and therefore labeled A, B, and C? This is a very important development that you've arrived at, because you're already saying to yourself, well, looking ahead, perhaps over the medium term, prices will most likely move in an upward direction. What happens in between that might be a little tricky to identify, but it is possible that we may see a decline in price action before prices start to move higher once again. Therefore, if we see the decline in price action, do I want to get involved in that move? Or do I wait for this area to try and capture an early entry for the trend higher in wave C? That'll be up to each individual trader to determine with respect to their trading preferences. Okay, so we have a possible future map for the way in which price action is likely to trade. Fibonacci retracements are always very important because they represent mapping points. One piece of important information that we might like to add to our overall strategy is just to simply gain an observation as to where the Fibonacci retracement levels lie. If we go back to the chart, we can very easily just select Fibonacci retracements in this particular instance, identify the high and the low that we'll use as a reference point, and we can then clearly see what our Fibonacci retracement levels are. For our purposes, we'll focus our attention on the 38.2%, the 50% retracement, and the 61.8% retracement. If we look at an updated chart of the dollar index, we can see that the market did move higher and has actually breached the 38.2% level. Does that mean that in time the market will move up towards the 50%? And if that is broken, does it mean that the market has a higher probability that it'll move up to the 61.8% level? Time will tell. So we are able then to identify our retracement levels. We have the 3 that we just looked at in the live chart. And you can see that at the time of drawing this chart, price action hadn't actually penetrated the 38.2%. In the past few weeks, we have had a move higher. So just to recap some information that we have over here, we've been able to establish the convincing argument that the market, or that the trend, has indeed reversed from bearish to bullish. We've been able to identify our Elliott wave structure, and that tells us that over time we still need to complete a 3-wave structure, which then tells you that the underlying broader direction in price is likely still to be in an upward fashion. If we do see a pullback, we can then consider that to be perhaps wave B of the pullback, the second of the 3 waves. If we can identify the low end of wave B, then that potentially could give us a good trading opportunity to try and capture the direction of wave C. So you can really get a picture by employing all these various tools and techniques and methodologies around technical analysis. We are clearly on course to formulating a very clear picture in our mind, which will further help facilitate the way in which we will then approach a trading market. So you have a map, so to speak, in front of you.